shall do two more financial statements, which would be the income statement and the statement of retained earnings. Both the income statement and the statement of retained earnings are flow statements. You may remember flow statements are statements which look what happened to a firm over a period of time. So the income statement measures the income which a firm has over a year. The statement of retained earnings measures how much change there is in retained earnings over a year. Now, the concept that we had from lecture 1, the second concept, was that the total from a flow statement, for example, the cash flow statement, gave the change in a stock quantity. For example, how much cash the firm had. Similarly, in the statement of retained earnings, it uses flow quantities like net income to compute how much change there is in a stock variable, the stock variable being the retained earnings. So at the bottom of the income statement, you're going to have the income for the firm over the year. Now, you may ask that, shouldn't the increase in retained earnings equal net income? So if the firm has an income of, let's say, $1 million, shouldn't its retained earnings go up by $1 million? And the answer is no, because all that income may not be retained. For example, some of it can be paid out as dividends. So if the firm pays out $200,000 dividends and it had a net income of $1 million, then, and there's no other impact on retained earnings, then the increase in retained earnings should be $800,000. So now we shall look a bit more in detail about what are the items in an income statement. So an income statement will have revenues which are going to be added to get income, and some expenses which are going to be subtracted. For example, raw materials, SG&A, which stands for selling, general and administrative expenses, insurance, interest, depreciation, tax, etc. So these are the various expenses that would go into an income statement, and also revenues would be added on to get net income. The item SG&A includes salaries, advertising, payroll, these kind of expenses. Now, revenues can be from sale of goods. Revenues can also be from rent, for example. The income statement is also known as the profit and loss statement. The statement of retained earnings has beginning retained earnings. So that is the retained earnings which was there at the beginning of the year, which came from the end of the previous year. Net income. So if the firm has an income during the year, it could change the amount of retained earnings it has. And also, the statement of retained earnings accounts for items like dividends, because dividends are actually income which is not retained, but rather it is paid out. Now, the statement of retained earnings can appear in the balance sheet, or it can appear combined with the income statement, or it can appear separately. So firms have flexibility in how to report the statement of retained earnings. And there is the statement of retained earnings is also called the statement of changes in earned surplus or the statement of owner's equity. So now we are ready to do a few questions, and we shall begin with questions on income statement. So here we have a firm which has revenues of 50,000 during the year 2005. It has SG&A of 30,000, and depreciation of 50,000, interest of 3,000, and tax of 4,000. So we are first going to prepare the income statement. So the very first item is revenues, and revenues are 50,000. SG&A is 30,000. That is to be subtracted. Depreciation is also to be subtracted. Interest and tax are also to be subtracted. So the revenues minus these other four items will give you $8,000. So the net income for this firm is 8,000 for the year 2005. Next, we would like to prepare the statement of retained earnings. For that, we need net income, which we have computed. So it's the same firm, and now we wish to prepare the statement of retained earnings. The information we have is that at the end of 2004, which is the beginning of 2005, the firm had retained earnings of $100,000. During 2005, it paid dividends of $10,000. So this information plus the net income information is enough for us to calculate retained earnings at the end of the year. So now we have the statement of retained earnings. So the first item is beginning retained earnings. And that we are told is 100,000. To the beginning retained earnings, we will add net income. If no dividends were paid out, then retained earnings would have increased by the amount of net income. But some dividends are paid out, so we'll have to subtract that. But first we add net income, and net income we have from above is 8,000. After that, we have dividends paid. And dividends paid are 10,000. And that will give us the retained earnings at the end of the year. So ending retained earnings will be 100,000 plus 8,000 minus 10,000. So that will be 98,000. The retained earnings have gone down over the year. And why has that happened? Because the firm has paid out more dividends than its net income. And it had net income of 8,000, but it paid out dividends of 10,000. Where could this 10,000 have come from? The extra 2,000 could have come from, let's say, cash. So it's possible that the firm decreased its cash by 2,000 to make up the deficit between its net income and dividends. Or it could have got it from some other source. So, because the firm has paid out more dividends to its equity than it earned for them, the amount of earnings it had for its equity holders over the year was 8,000. However, it paid out 10,000 to the equity as dividends. What that resulted in is that the retained earnings, which is owned by equity, went down by 2,000. Now we have discussed financial statements. There are some other parts of an annual report. These are three. Firstly, you have a management discussion and analysis. Second, you have notes to financial statements. And third is an auditor's report. The management discussion and analysis is a discussion of the firm's performance, past and present. There are some examples of management discussion and analysis that you can find on the internet. For example, Microsoft and Hershey. I have given you the URLs for these management discussion and analysis in your notes. So you should look at them. In the Microsoft management discussion and analysis, the management of Microsoft discusses Microsoft revenues, products, etc. In Hershey's case, they discuss operations, financial conditions, and other things. In notes to financial statements, there are explanations and additional information about financial statements. For example, what kind of accounting rules were followed, if there were some things which the investor should note. There are a couple of notes to financial statements which I have found for you on the internet. For example, Dow Chemical Company and Rolls-Royce. The third addition to an annual report is the auditor's report. Now, this is prepared by an independent outside auditor. Firms which trade on the market are required by law to have their accounts audited by an independent outside auditor. If the auditor gives an unqualified opinion, it means that the auditor is satisfied with the financial statements which are being presented. Following the Enron scandal and other accounting scandals towards the end of the last century and beginning of the 21st century, the US government changed its laws, and the important one was the Sarbanes-Oxley Act. Since this law, the auditor's report has become more substantial because the Sarbanes-Oxley Act requires greater responsibility to be taken in the reporting of financial statements.